Trading the blackout. How smart money profits from grid instability. In late 2025, the PJM interconnection, the largest power grid operator in the United States, concluded its capacity auction for the 2026 to 2027 delivery year. The results sent shockwaves through the energy sector. Capacity prices hit an absolute regulatory ceiling of $329.17 per megawatt day. That is a staggering 22% jump from the previous auction, which had already seen prices explode nearly tenfold. Grid operators are forcing consumers to pay over $14 billion just to guarantee that power plants will be available to turn on 3 years from now. The mainstream media blamed this entirely on the explosive power demands of AI data centers. But for senior electrical engineers and institutional energy traders, that is only half the story. The grid operators are panicking because the United States grid is losing its physical weight. Today, we are looking at the death of grid inertia. We are going to break down the terrifying physics of trying to balance a grid without heavy spinning mass, the harsh realities of high-voltage transmission line losses, and how institutional capital is utilizing smart money concepts to actively trade the volatility of a fragile braking system. The American power grid operates on a strict heartbeat of exactly 60 Hz. If that frequency drops even slightly, the entire system can cascade into a catastrophic blackout in seconds. For the last century, we maintain that heartbeat through something called grid inertia. Inside traditional coal, nuclear, and natural gas plants, there are thousands of tons of steel turbines spinning at 3,600 revolutions per minute. This massive physical rotating weight stores a tremendous amount of kinetic energy. If a massive power plant suddenly trips offline, the sheer physical momentum of all the other spinning turbines on the grid acts as a giant shock absorber. They literally drag the frequency forward for a few vital seconds, giving the grid's digital relays time to react. But the grid is fundamentally changing. We are rapidly retiring heavy, spinning thermal plants and replacing them with inverter-based resources like solar and wind. These renewable sources are vital for the energy transition, but they have zero physical mass. They do not spin. As we remove the heavy iron, the grid loses its inertia. It becomes light, twitchy, and incredibly fragile. Without that kinetic shock absorber, a sudden surge in demand from a hyperscale data center or a transmission fault can cause the grid's frequency to plummet violently, threatening to tear the network apart. To compensate for the loss of local grid inertia, grid operators must import stabilizing power from regions hundreds of miles away. But this introduces another brutal engineering reality: transmission line losses. You cannot move electricity for free. When we push massive amounts of power through high-voltage transmission networks, often utilizing 400 kV or 500 kV lines, we are fighting the physical resistance of the aluminum and copper wires. The farther the electrons have to travel, the more energy is bled out into the open air as pure heat. In large interconnected power pools, these transmission line losses can consume a significant percentage of the total generated power. We are essentially building a massive, multi-billion-dollar machine that actively bleeds its own product before it even reaches the end consumer. The loss of grid inertia forces us to rely on long-distance transmission, and the physics of long-distance transmission forces us to burn capital just to keep the voltage stable. Where engineers see a fragile system, institutional capital sees unprecedented opportunity. Because the grid lacks inertia, wholesale electricity prices have become arguably the most volatile asset class on the planet. A sudden drop in wind generation combined with a heat wave can cause real-time energy prices to swing from $30 to $5,000 per megawatt hour in a matter of minutes. Energy markets are now behaving exactly like highly liquid financial markets. Institutional trading desks are applying smart money concepts directly to the power grid. They are analyzing the physical supply bottlenecks, like the transmission line constraints we just discussed, and identifying massive, macro-level fair value gaps in regional pricing. But the ultimate hedge against this instability isn't just trading paper contracts. It's controllable load. Large-scale Bitcoin mining operations, particularly in deregulated markets like ERCOT in Texas, have essentially weaponized this volatility. Because Bitcoin miners can power down their ASICs in seconds, they act as synthetic grid inertia. They lock in cheap power contracts during the baseline. But the moment the grid stresses and a massive fair value gap opens to the upside, these operations instantly shut down their rigs and sell their power back to the grid at a premium. They aren't just mining digital assets, they are actively trading the structural fragility of the United States power grid. The $329 capacity prices we are seeing in the PJM interconnection are not an anomaly. They are the new cost of survival. We are paying billions of dollars just to keep heavy iron spinning because we haven't yet figured out how to build a fully digital grid that doesn't collapse under its own weight. The intersection of high-voltage engineering and institutional market mechanics is creating the greatest wealth transfer in the history of the energy sector. The smart money knows that whoever solves the physics of grid inertia and transmission line losses will control the economic future of the digital age. If you want to stay ahead of the exact macroeconomic and engineering forces shaping our global infrastructure, hit the subscribe button. We'll be bringing you deep, uncompromising analysis every single week. Until next time, this is USA Grid Mechanics.